Welcome to this in-depth guide on how to read a balance sheet. No matter if you are a beginner or an investor looking to understand companies better, by the end of this video, you'll know how to read every line of a balance sheet and analyze a company's financial health confidently. What is balance sheet? A balance sheet is a financial snapshot of a company at a particular moment in time. It shows what a company owns, what it owes, and what's left for owners, also called for shareholders equity. It's built on simple formula. Asset is equal to liabilities plus equity. This formula must always be balanced. The three main sections of balance sheet. Every balance sheet is divided into three major parts: assets, what the company owns; liabilities, what the company owes to others; shareholders' equity, the net worth of the company. Assets section. Assets are the resources a company owns. Assets are divided into two types: current asset and non-current asset. Current assets are items that can be converted into cash within a year. These include cash and cash equivalents. This is most liquidated asset. Accounts receivable, money owed to the company by customers. Inventory, products that are ready to be sold. Marketable securities, short term investments that can be sold easily. Prepaid expenses, payments made in advance for services. While analyzing current assets, look for: is cash increasing or depleting? Are receivables under control or are they pulling up? Is inventory moving fast or stuck? Next time, we have non-current assets or fixed assets. These include property, plant and equipment (PPE), factories, machines and buildings. Intangible assets, patents, trademarks, goodwill. Long-term investments, investments that are intended to be sold within a year. While when analyzing non-current assets, check: is the company investing in productive assets? How much of their assets are intangible? Is depreciation properly accounted for? Liabilities section. Liabilities are the company's obligations, debts, and obligations to outsiders. Liabilities are also divided into two types: current liabilities and non-current liabilities. Current liabilities are the obligations the company must pay within a year. Accounts payable, bills the company needs to pay to the suppliers. Short-term debt, loans or lines of credit due within a year. Accrued expenses, expenses that have been incurred but not yet paid. Unearned revenue, money received in advance for services or goods. While analyzing current liabilities, ask: can the company cover its short-term debts with its current assets? Is the accounts payable increasing faster than revenue? Non-current liabilities are long-term debts and obligations such as long-term debt, loans, bonds, or other financing due beyond a year. Deferred tax liabilities, taxes that are owed but deferred to the future. Pension obligations, future payments owed to the retired employees. When reading liabilities, be cautious of high levels of debt compared to assets. Interest payment burdens, whether the debt is increasing faster than the company's assets or earnings. Shareholders equity section. Shareholders equity represent the owner's share of the company after all liabilities has been paid. It includes common stock, the value of shares issued to shareholders; preferred stock, shares with special rights over common stock; retained earnings, profits that the company has reinvested instead of paying as dividends; additional paid-in capital, money paid by investors over the par value of shares; treasury stock, shares bought back by the company; Key things to look for: is the company retaining profits or distributing most of it as dividends? Are they consistently buying back shares, reducing treasury stock? How much of equity is coming from actual earnings versus share issuance? Important balance sheet ratios you must know. Current ratio. Current assets upon current liabilities tells if the company can pay its short-term debts. A ratio above 1.5 is generally considered good. Debt to equity ratio. Total liabilities upon shareholders' equity measures financial leverage. A high ratio means the company is using a lot of debt to finance growth. Return on equity (ROE) is equal to net income upon shareholders' equity. Shows how efficiently the company is using its equity to generate profit. Higher ROE indicates better performance. How to analyze a balance sheet like a pro. Compare assets versus liabilities to see the company's solvency. Check the liquidity through current assets and current liabilities. Observe trends over multiple periods. Is the company building assets or increasing debt? Look into retained earnings. Is the company reinvesting wisely? Be cautious if intangible assets form a large part of total assets. These can be overvalued. Common red flags in balance sheet: low cash levels and high current liabilities. Liquidity risk. Rapidly increasing accounts receivable could indicate bad debts. Excessive inventory. Unsold products piling up. Very high debt compared to equity. Over-leveraged company. Negative retained earnings. Past losses eroding company's value. Conclusion: learning to read balance sheet is essential for smart investing. It tells you about a company's strength, risk, and financial habits. By reading balance sheet regularly, you will develop a sharp eye for spotting both good opportunities and dangerous companies. Remember, always combine balance sheet analysis with income statement and cash flow statements for a complete financial picture. If you find this guide helpful, make sure to like, share, and subscribe for more financial content. Comment below if you want me to explain income statement and cash flow statement next. Thank you.